Right now, I want to tell you about a tool that can help you make money quickly. And there's nothing wrong with quick money. But it's also incredibly risky with a high chance of blowing up in your face if you don't know what you're doing. Investing in initial public offerings, IPOs, which, believe me, all my life I've heard people think they could catch the hot ones. They have no idea what they're doing. You will now have the edge on them after tonight. IPOs are sexy. They are talked and written about endlessly, right? You keep, oh, look at that, opened up 10 points. But you're hardly ever told what to actually do with them. That's one of the things I wrote about in Getting Back to Even. I'm going to teach you the basics right now, right here, because when you know how to tell the difference between an about-to-be public company that will soar and one that will go down in flames, you can quickly rake in some stupendous profits, and I want you to get those profits. The lure of IPOs is that when you nail it, when you get it on the right one, you can have gains of 20, 30, even 50% in a day, or in some cases, just minutes. The instantaneous nature of these profits makes them incredibly attractive, but they can also often get in the way of your better judgment, cause you to invest in initial public offerings that end up stinking up the room. It is heady. It can be dangerous. We've got to establish some rules to stay out of here and go into there. As helpful as these profits can be, don't let the brokers trick you into believing that buying every IPO is a great way to make money. And the real challenge is just making sure your broker can always finagle you some shares. Wrong, wrong, wrong. In fact, some initial public offerings aren't worth investing in at all. The investment banks will always try to slip in some clunkers after they have lulled you into thinking that all the deals work. That's what it happens. You don't know that, now you do. Now, partially because the performance of newly public stocks tends to be all over the map, especially in the first day of trading, and partially because there simply isn't that much available information about newly public stocks beyond the prospectus. There's a tendency to assume that the success or failure of a given IPO is mostly a question of luck. That's also wrong. I think you can accurately try to figure out which IPOs to write off as uninvestable and which ones deserve to be bought. Separating the IPO wheat from the chaff isn't about luck. It's about analysis. It's the kind of homework that professional money managers do in their sleep all the time, and that I advocate endlessly and tirelessly on the show. I know the pros have it right because every day I would analyze stocks the exact same way back at my old hedge fund. And that's how I still do it. I made a boatload of money for myself and my clients in my old hedge fund by gaming IPOs. No sin in gaming, okay? Because I'm not necessarily asking you to be a long-term investor and stuff. I want you to know exactly how I did it using the methods I lay out in Getting Back to Even. Here's some inside baseball that you need to know about IPOs. I think the investment banks that underwrite all the deals have their own agenda. One that I believe is often as much about bringing people, regular retail investors, back into the game as it is about helping their clients raise money in the equity markets. One of the things I learned in my many years on Wall Street, both hawking stocks and bonds when I was a broker at Goldman Sachs and managing money for myself and for rich people in my hedge fund, is that when the market turns south, when it becomes really difficult to make money, and people start pulling out of stocks altogether to go to the sidelines, I think the brokers like to throw investors some easy wins, lure them back in the casino, lay up IPOs that are intentionally underpriced so they will pop and you'll get excited and want to get back in. Why do I think they would underprice the deal and shortchange their investment banking clients on the other end? Because it's just as important to the brokers that their other clients, the ones who pay commissions like you, whenever they trade stocks, keep being interested in the market. And for most investors, the gains from a sweet, underpriced IPO are a fabulous reason to feel good about owning and buying stocks again. When times are tough, the brokers want to entice you back. They want to get you in. And they know that there's nothing like getting in from easy IPO money. For the anatomy of a fabulous IPO that fits this pattern, why don't we take a look back to March 19th of 2008. It's an entire year before the market bottom, when 41 investment banks and boutique brokerage houses underwrote, at that point, the largest IPO in U.S. history, the IPO of Visa. At the time, the IPO market had been truly crummy. The stock market miserable. People were thinking all you did was lose. And I think the brokers just wanted to give their clients, their trading and investing clients, not the big guy, the investment banking client, a slam dunk. So they underpriced Visa, one of two massive credit card issuers, along with MasterCard, at $44 a share. $44. Do you know that caused a pop? It went as high as $69 during that trading day, before closing at $56.40, 28% gain if you got a piece of this huge IPO. The brokers knew that Visa would be hot. in part because they knew that the market loved MasterCard, Visa's rival. They also knew that if they priced Visa substantially cheaper than its comparable rival, investors would throng to the offering, maybe selling MasterCard to pick some up, which is what they did. Even though the new issue was the biggest in stock market history, the brokers tightly controlled the supply. They parceled it out to accounts that they believed would not flip the stock, just sell it as soon as they got it, and gave out just enough to the large mutual funds that they would be able to start their positions but not finish their positions with the stock they got on the deal. That way, the mutual funds' appetites whetted, would come into the secondary market, that's the regular stock market, and bid Visa up so they can get what's known as their full position. These guys, they might get a quarter of the stock that they need on the deal, then they have to go buy 3/4 in the aftermarket. Never forget the trick to a successful IPO is what's known as the rationing process. The syndicate desks know how much the big mutual funds ultimately need to be able to have enough Visa to affect their performance and get that full position. They know because they trade with them all the time. So they give them a percentage. It's usually a third to a half of what they need. That forces the client's hands to complete the size of the position. They're not going to hold on if they don't have all the stock they need. Of course, they could flip the positions themselves, but the brokers have ways to monitor who takes that quick money. And they will not be allowed to get big allocations the next time around. They enforce this. You benefit because the syndicate desks almost always save a lot of stock for retail investors like you, as the brokers know that retail investors are more likely to hold on to stock. They don't play the flipper game. I'm indifferent, really. I'm indifferent to whether you flip or not. I am concerned about you making money. But the one thing I don't think you should ever do is go into the aftermarket and buy stock. Meaning, I don't want you buying new IPO on the open market after it started trading, particularly after it popped. If you don't get it on the deal, forget about it. You and I will catch the next one. You are in a much better position than that of a mutual fund. You don't need to buy a lot of stock well above the offering price in order to be assured that you got your full position. Keep these IPO mechanics in mind.